Welcome back to our intermediate financial accounting class. In this segment, we're going to continue our discussion of the accounting cycle. Now, so far, we've already done a lot with the cycle. We've talked about what it is and why it's important, the accounting equations and how they fit in. We've talked all about what the cycle is intended to do and why that's important to business leaders. And then we went through and started looking at specific segments of the cycle. Specifically, we looked at making journal entries, and we looked at posting. And then, once we'd done the posting, then we started using that simplified equation to come up with ending balances. We also used that equation to do some other things, additions, subtractions, what our beginning balance was. Whatever number we need as an accountant to do our job, we can use that equation to get to. Now, in reality, the computer program that's doing our T accounts is not going to have that equation. What it's going to do is say, okay, it's got a beginning balance, that's a debit, here are all these other debits, then I'll add those in, and I've got these other credits, I'll subtract those out, and that will give me an ending debit balance. Or if I start with a credit, I do it the opposite way. I add in the credits, subtract the debits, and end with a credit balance. That's what the computer system does. Okay? But the equation that we did, well, that was a key idea that we need to use as accountants to kind of simplify things when we don't have time to add up every single line item in the T account. Okay? Now, once we've got ending balances, whether from the computer or from our shortcut equation, it's time to move on to the next set of the cycle. And here it is. We're going to go ahead and make our first trial balance. Now, we do 3 trial balances throughout the cycle. So let's just talk about what a trial balance look like, at least the basics. So first off, there's a very specific order. We do the assets first. Now, what order those assets are listed in, that depends on your preference as an accountant, depends on the company's policies, etc. But the assets all get lumped together. Then we do the liabilities, same idea. They may shuffle a little bit in there, but they're all the liabilities are together. Then we do equity, dividends, owner's investment, withdrawals, common stock, additional paid in capital, all of those equity accounts. Then we do our revenues, then our expenses, gains, and then losses. So it's a very specific order as far as the categories go. Within the categories, well, there's some play depending on the company. In addition, there's some basic formatting rules. So if an account doesn't have a balance, we don't put it in. We don't want to waste people's time with zero balances because people who are reviewing these need to go through them very quickly. So we only put in the accounts that actually have a balance at the end of the year when we're making this trial balance. The other thing that we'll do is we'll make sure at the bottom there is a total. That's what this trial balance does, is it checks and says, all right, really, were all of your debits and credits equal in your journal entry, and did you get them posted correctly? At least as far as the debits and credits go. Trial balance won't tell you, well, you put this into advertising expense and it should have been rent expense. It won't check that. But it will check, hey, that was supposed to be a debit to rent expense. You put it in as a credit. Now you don't balance anymore. And that's what these trial balances are for, is to check that posting and that debit and credit balance. So we want to make sure at the bottom we have our debits and our credits. The other thing that you'll see in almost all trial balances, down at the bottom, I'm going to draw one of my famous pictures here. So here's our trial balance. And we'll list all of our account names, and then we'll have our debits and our credits, and we'll list all these different balances. And at the very bottom, there'll be this total line, and we'll add up the total debits and the total credits. And then as accountants, or as bookkeepers, we signal that they balance and they're correct, and we're done by putting in the famous double underline. That's what that underline means. It means not only are we done with our work, but it balances the way it's supposed to. So make sure those are in there. It's an important signal to those who are doing a review. That's what a trial balance does. And there's really not a whole lot more we can say about it. Just make sure that you got the debits and the credits in the right columns. Make sure you put in that total line, and make sure that you leave out anything with no zero balance. Good news, most of the time a computer program will do this for you, but you should at least know what the computer program is doing. Next, once we've got our trial balance done, and the debits and credits match, we've done that first check on all of our normal journal entries. Now we can move on to the adjusting entries. And this is a process of going through all of our different transactions and looking for things that maybe haven't been recorded yet. Something has happened and we haven't done a journal entry for it. That's what the adjusting entries are for. At the same time, since we're going through and checking all of our journal entries anyway, we will also go through and look for anything that's wrong. It's not an adjusting entry, it's what's called a correcting entry. But you'll often see companies doing a bunch of correcting entries and adjusting entries at the same time. Again, because I've done one big review, I found mistakes, make a correction, and I found things that just haven't been recorded yet. That's an adjustment. So there's lots of different examples of what qualifies as an actual adjusting entry. Here's a few of them. Recording your lease payments. We may have some work contracts with people that I've done some of the work for now, and I get to show some of that revenue because I've completed an obligation. There could be insurance contracts. I prepaid. Now I've used up some of that time that I paid for. Taxes are another good example. I owe the taxes because of what I've done through December, but I won't actually send a check until April when those taxes are due. So I make an adjustment. I owe those taxes and I need to show that I owe them, even though cash hasn't gone out. And that's what most adjusting entries are. They're the issues that have happened, things that have occurred, even though I haven't paid for them yet. And that's really what I'm looking for. What I'm hoping is by capturing all of those different pieces, then when I create an income statement and a net income number and a total assets and total liabilities, etc. number, I'm providing my investors with more value. I'm not just showing the cash flows. I'm showing them everything that's occurred, whether I paid for it or not. This is the basis of accrual accounting. And unless you're a small business, mom and pop shop kind of a thing, doing everything with a checkbook, this is the best way to do it. This is GAAP, is to record these adjustments. Now, before we go on and talk about how we do this, let me just mention that idea of why we do an adjusting entry is a key concept in this chapter. Okay? So let's go ahead then and talk a little bit more about adjusting entries. There's four main categories. The first couple are not the most common. A prepaid expense means that I have gone out and I've paid for a year's worth of insurance, I've paid a year's worth of rent, and I need to record either the fact that I've prepaid instead of done it, instead of using this up, like I got a bill and I paid for it. No, I paid it before the bill came due. In addition, unearned revenue. Since I haven't done the work yet, we talked back in our conceptual framework lecture about the fact that you have to do the work before you can record any revenue. So if they paid me and I haven't done anything yet, I have to show that as a liability. I owe them that work. That's an adjusting entry. The third one is the most common. I have accrued an expense that I haven't actually paid for yet, or I have a liability, something that I owe. I'm involved in a lawsuit, or I've issued a warranty, or I've issued a coupon, and I'm on the hook when people bring those back. Those happen all the time. Accrued assets and revenues, we rarely get to do this. It does happen occasionally where I've done the work and finished the job, but they haven't paid me yet, so I could record an accounts receivable and some revenue now. So all four of them happen. It's just that third one's the most common. Two things that we're looking for specifically when we're going through to do adjusting entries, kind of key clues. Number one, any accounts that haven't been updated. So I've got a bunch of rent expense usually every year. I don't see any yet. Okay, chances are there's an adjustment that needs to be made. Or it could be that you have an account that's just got a really big balance. So I'm going through my books and I find that I've got a lot of supplies on my books. And I know I've just walked by the supply closet. I don't have that many supplies. Then I need to do an adjusting entry. I've used them up and not recorded that I used them up. I got to fix that. So a little distinction here. A correcting entry, that's where I did an entry and I did it wrong. An adjusting entry is I just haven't done an entry yet at all. I need to do an entry. Okay, so it's not a correction. It's something that allows me to update my books and get them as accurate as possible with what's happened over the course of the period. So let's start by talking about the steps to a correcting entry, and then we'll talk about the steps to an adjusting entry, and we'll go from there. When we find an error, we've gone through, we've found a mistake, we realize something hasn't been recorded at all, even though cash went out. Okay, that's not an accrual, that's a whoops. Here are the steps that I go through. Step number one, write down what you did. What did I do? What journal entry did I make? Step number two, write down what you should have done. So now you've got the two side by side. 3, look at the journal entries and compare them and decide, well, what really needs to be changed? So you might find some accounts are okay, and there's just a couple of them that need to be tweaked. So write down the changes that need to be made. Determine whether you need a debit or credit to fix it. Figure out how much you need to debit or credit in order to make the correction. And finally, throw in a description saying that I made a correcting entry because I blew this journal entry on December 15th or something like that. Okay. Now, sometimes you'll get in and you'll realize, I just can't fix this. And when you can't fix it with a journal entry, then you actually have to go back, dig through your books, find the mistake, that actual journal entry for the mistake, and fix that entry. So again, just to wrap up this idea of correcting entries, either I did it wrong or cash was involved. Adjusting entry, things have happened that I have not recorded or paid for yet. So I'm going to adjust my books to keep track of those. With the correction, if I get in and I realize that, when you did your journal entry, you debited cash for $450 and you credited accounts receivable for $500, this kind of a shortcut isn't going to work for that, unfortunately. It's not going to work at all. So that's something that you actually have to go back and find it. You can only fix the entry with these steps, these correcting entry steps, if it balanced in the first place. As long as it balanced, you can do it. If it didn't balance, you got no choice. You got to dig back through the books and find it. Let's take a look then at the steps to adjusting entries. Step number 1, figure out what adjustments need to be made. So you're going through your books, you're finding out, okay, this happened, I haven't recorded it yet, I need to record it, so I need to make an adjustment. Number 2, decide which accounts are affected. And there are 2 rules here. Rule number 1, if you even think about using cash, it's wrong. An adjusting entry never, ever, 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 highlight it, circle it, star it, never, ever uses cash. If there's something that you've missed that cash was involved in, that's a correction or a mistake. You've got to go fix it. An adjusting entry never includes cash. It's non-cash things that have happened and not, because they haven't had cash involved, they haven't been recorded yet. So, never use cash or it's wrong. The second thing is there will always be a balance sheet account or permanent account, and there will always be a temporary account, an income statement account. So this is like, I have to show that I owe these wages, so I'm going to show a wages expense, and I'm going to credit a wages payable. Liability, balance sheet account, expense, income statement account, or temporary account that gets closed into back into retained earnings or into equity when I'm done. So there'll always be those 2. Number 3, I should have brought these up as I went. Sorry about that. Let me put them up now so you've got them. Again, never cash, always has the 2 accounts. Number 3, decide how each account is being affected. So you've decided on the accounts, decide whether they're debits or credits, then figure out the amount, and finally, we're going to add a detailed description. And you'll notice I've kind of highlighted this. The description on an adjusting entry is much more detailed than the normal entry. If you went through our example of doing normal entries, you probably noticed that there really was not a whole lot involved in making the description on those journal entries. And that's true. We just don't put in a lot. As long as somebody can kind of zip by and say, oh yeah, that's what that was, then we're good. Adjusting entries are different. Adjusting entries receive much more scrutiny from auditors, much more scrutiny from managers, much more scrutiny from those who come after us who have to make the adjusting entries next year. That's actually another clue. Easiest way to find out what adjustments have to be made, go see what you had to do last year. Chances are you have to do about the same set. Since they're going to be reviewed so carefully, you have to give more detail. You want to put in a description that says this is an adjusting entry for wages expense, and then I'm going to include my equation. This is how I made the calculation and got to that number that you see in the journal entry. That's the best way. That way, anybody coming behind and doing it afterwards knows exactly what you've done. So please make sure you give a detailed entry. We're going to go ahead and stop there. We've talked about a lot of conceptual stuff. I'd kind of hoped to do an example, but turns out we've run kind of long. So I don't want to keep going. I want to give you a break. Go get yourself a pencil and a paper, and then when you come back, we'll do some actual entries.